Hi, I'm Nicole Brennan, macro analyst at Alphatica. This has been the most important macro week of the quarter. Consumer prices on Tuesday. Producer prices this morning. Beige Book this afternoon. Bank earnings across the board. Here's the full picture and what it means for your portfolio. Start with the headline. Producer prices came in at negative 0.3% month over month. The street expected flat. That is a significant downside miss. Core prices, excluding food and energy, came in at plus 0.2% versus 0.4% expected, half of what was forecast. And it gets better. May's produce prices were revised down from plus 1.1% to plus 0.6%. That is a massive revision. The inflation that the market thought existed in May was nearly cut in half. Combine this with Tuesday's consumer prices at negative 0.4% month over month, core at 2.1% year over year, and you have two consecutive inflation reports telling the same story. The disinflation trend is accelerating. The Beige Book confirmed it this afternoon. 11 of 12 Fed districts reported economic expansion. Prices rose moderately, but price growth was steady to slower across all districts. Some contacts expect further easing as fuel costs come down. Now here's the line from the Beige Book that connects everything. Manufacturing activity was specifically supported by data center demand, machinery, and defense spending. The AI capex cycle is now showing up in the Fed's own regional economic surveys. This week alone, Morgan Stanley raised hyperscaler capex estimates to $1.4 trillion through 2028. Meta announced another $40 billion for a Louisiana data center, bringing total AI infrastructure commitment above $250 billion. IBM's CEO said clients shifted spending away from legacy infrastructure toward servers, storage, and memory. And now the Beige Book cites data center demand as a manufacturing driver. Every data source this week, from Wall Street to the Fed, is confirming the same cycle. AI capex is real, it is accelerating, and it is now large enough to show up in macroeconomic data. What does this mean for rates? A July hike is off the table. Two consecutive soft inflation prints with downward revisions to prior months give the Fed no justification to tighten. Markets were pricing 34 basis points of hikes through year-end coming into this week. That number is compressing rapidly. Fed Chair Warsh testified yesterday and today. He called AI a supply shock happening faster than he projected. A supply shock is disinflationary. If the Fed chair views AI as adding to supply rather than demand, the inflation case for hiking weakens further. Now the actionable part. Two names are best positioned to benefit from the convergence of cooling inflation and accelerating AI capex. First, Meta. Morgan Stanley's top pick. The street has penalized Meta for AI spending but given it no credit for potential AI revenue. Total infrastructure commitment now exceeds $250 billion. Meta has 3.5 billion monthly users to monetize AI through. Zuckerberg pushed back on excess capacity concerns, saying the company needs all the compute it can get. If rate hike fears continue to moderate, the multiple compression that hit Meta in June reverses. Second, Google. Morgan Stanley maintains overweight with cloud and AI revenue poised to accelerate. Google's advantage is the existing cloud infrastructure that generates revenue today, while the AI build-out scales tomorrow. Google Cloud grew 28% last quarter. TPU demand from external customers is backlogged, and Google is one of only two hyperscalers, along with Amazon, where cloud revenue can immediately monetize AI capex without waiting for a new product to ship. Both names benefit from the same setup. Cooling inflation reduces the risk of rate hikes that compress growth multiples. Accelerating AI capex drives top-line growth, and both are spending aggressively while the market is only pricing the cost, not the revenue. The macro picture in one sentence. Inflation is cooling, the economy is expanding, AI capex is accelerating, and the Fed has no reason to hike. That is the most constructive setup for growth stocks we have seen in 2026. SPY is 1% from all-time highs. The data this week says it gets there. This is Alphatica. We track the data.